Okay, beautiful. So welcome to the 2025 forecast. Look, this is the thing about forecasts, especially in the mortgage and real estate industry. For the past 2 years, we've been nothing but early to the reality.
No,
I don't like
sucked.
to I don't like to
We
say that
sucked, bro.
I don't like to say that we were wrong. I just want to say that we were early. But look, the reality is for the past 2 years, we've been saying that the rates were gonna drop in the next 6 months, and in the next 6 months, we're gonna see rates in the 4%, in the 5%. There was an article by Fannie Mae that said that by the end of last year, we're gonna have rates in the 4.5%, and clearly that hasn't happened. So what we want to do today is we want to try to, how do you say, redeem ourselves. We want to try to redeem ourselves and tell you everything that we're looking at in order to make the predictions that we make.
So we're going to suck less.
We're going to try to suck less because here's the thing, guys. When we make predictions, it's not a matter of I want the rates to be low or I want this, but we look at a lot of different data, and that data points towards where the rates and where the real estate market should go. So what we're going to do today is, without making it boring, because we understand that, fundamentally this is not the sexiest topic, we want to go over all of that data, not granularly, but show you how that data affect things like the rate and like what real estate does with appreciation, and then land where we expect the rates and appreciation to be from a national level, also to a Southwest Florida level. Scott, anything to add to that fantastic intro?
To add to that, because we have been doing forecasts for both the interest rates and the real estate market. And I'm just saying the forecasting on the real estate market was correct, which I think was me, and the interest rates was my younger counterpart. Why? Because with age comes wisdom. Okay, so he is wrong on the interest rates, and I am right on the real estate market. But here's what you guys need to know. I took a lead on both areas today, so that way you got two.
The good thing about this, the good thing about this webinar is I control the camera. So the truth is, look, the reality of the situation is we have a lot of recordings of Scott being wrong throughout the whole year about what was going to happen with the rates. But this one is different because now we know we're right. So take it away, man.
All right. So let's look back at 2024, okay? There were 31% fewer U.S. homes sold in 2024 than pre-pandemic. And look,
pre-pandemic.
Yeah. I was just going to go there, right?
Go there.
We got to stop looking at the pandemic as the norm, because that was the weirdest crap that you'll ever see in this industry, okay? I'm 29 years in at this point, and that's some weird crap. So we're going to be looking at pre-pandemic numbers, because that was when things were normal, okay? 2018, 2019, the housing market was good. It was normal. So that is going to be our reference point, okay? We also had, though, which is not normal, the lowest turnover rate in 30 years. Why? Because people are in love with their 3-4% mortgages. They are not in love with getting a new mortgage at 6.5%, 7%. It was 8% in October. So that is a big factor. Okay, then to make things more screwed up here locally, we had not one but two hurricanes. Look, I relocated down here in like 96, and I had Charlie to think about all the way up through 2005. And in the last couple of years, it's like hurricane. This has driven up insurance costs. This has driven up everything. In addition to that, interest rates have remained high, as we know, okay? And there was a lot of economic and political uncertainty coming into the election. Now, I would say all elections bring forth some economic and political uncertainty. I would also say the past couple of elections probably had the highest amount. And whether you like or dislike the outcome is irrelevant. What matters is what John Q. Public is walking around thinking. And John Q. Public was thinking, I don't want to make a decision until we're past this election, and we are now past this election. So that was a snapshot of 2024. There was a lot of forces working against us. The hurricanes you couldn't have foreseen. The political climate, I don't think I foresaw it to the extent that we had it. So
well, and one of the biggest things that was hurting us last year, and this is, I believe this is the biggest mistake that we did as an industry, is we continue to promise this crazy promise of low rates right away. And Unfortunately, I think that even though we did a good job talking about different types of strategies, like the buy down strategy and like being able to refinance right away, it was very difficult for the consumer, for your typical consumer to think, okay, let me buy now, and then with the hopes of refinancing right away, as opposed to just waiting. If you're telling me that the rates are going to drop in 4 months, in 6 months, in 3 months, and they're going to drop drastically, then I might as well wait. And as an industry, we were all screaming everywhere, rates are gonna come down. And what that did is that made a lot of people just think, okay, then I'll just wait until rates come down. And all of these things, with the political uncertainty and the economic uncertainty, made a lot of people just want to wait. And that, by the way, is mistake number one from last year. Not so much that we were expecting the rates to come down, but us telling everybody that the rates were going to come down, I think ended us hurting us more than it ended us helping us.
I agree 100%. So let's talk about what moves the market, okay? The market is moved by 5 primary things. Number one is the Fed, right? The Federal Reserve obviously is the one that's raising and lowering rates, not mortgage rates directly. We'll get into that, okay? Inflation has been the thing that has been driving us through this entire freaking process, okay? I was the first to call it when this whole thing started, when the Fed said inflation is going to be short-term. They say transitory is their word for that. I was public. You can find the Facebook videos. I said they're dead wrong. I believe that they acted too slow on the inflation going up. I also believe that they're acting too slow now as inflation's going up. I believe they're repeating the same mistake. We'll get into that. Next, huge thing, the labor market. And I have to tell you, I have been surprised by how damn resilient the labor market has been, although we are seeing some cracks in it that we will talk about. Obviously, mortgage rates play a big role in inventory. And on the inventory front, we got to understand something, okay? We deal with a lot of people that are moving here from, as I choke to death,
He's dying.
from other parts of the country. And there are a lot of parts of the country that are still massively low on inventory. And you got to understand the psyche of the client. One question I recommend everybody ask every out-of-town client is, where are you from and how's the housing market where you are? Because we are licensed throughout the country, and I have people trying to buy homes in other parts of the country where they were offering 5 and 8% above list price and getting bid out in bidding wars with 15, 20 houses. So we have to understand that we're in a pocket of the country where inventory is elevated. Condos specifically, we'll talk on that as we go. But we have to understand that there are still large chunks of America where there is a massive inventory shortage. So let's start breaking this down one step at a time.
Okay, the first thing that we're going to talk about is the Fed. Now, we need to understand, first of all, what the Fed rate is. The Fed rate is the overnight rate that the government and that a bank is going to charge another bank overnight. So this is the shortest rate possible because it's from one day to the other. Every single night at the end of the day, or every single day at the end of the day, each bank needs to have a certain amount of money in their bank in order to be able to lend some money. So what the banks do is that they borrow from the government or they borrow from other banks. And this rate is what the Fed rate is the rate at which other banks lend themselves money and the government lends money to the bank. This has nothing to do with the mortgage rates directly. However, there's repercussions on what this Fed rate is going to be, and eventually it trickles down into long-term rate like a mortgage rate, which is a 30-year term. So the Fed rate, it's important because it's going to determine a lot of different things economically, and it can have a lot of influence on the mortgage rate. So when we look at the Fed rate, that doesn't mean that that's exactly the same thing as the mortgage rate, but there is a lot of correlation between the two. So where do we see the Fed rate go? Well, the Fed rate does something called the Fed dot plan. And the Fed dot plan, what they do is they basically get together when they get together and they go, okay, this is where we think the Fed rate is going to be. And each member votes one time, and that's each dot that you see. It's basically where the member thinks that at the end of the year, the Fed rate is going to be. Right now, we are at a 4.375. So to translate this into plain English, what this means is that one Fed member thinks that the rate, because there's only one dot there, that the Fed rate is not going to change. 3 Fed members think that it's going to be 4.125, and then the
So that's one
majority
cut.
of them.
That's one rate cut.
That's one rate cut, correct? That's one rate cut of 25
Right.
basis points. And the majority of them, 10 Fed members, think that by the end of next year, or this year, sorry, the Fed rate is going to be at 3.875, which means we're going to have 2 Fed cuts. Now, this doesn't mean that they can change their mind, they can accelerate, they can decelerate. At the beginning, or I'm sorry, last year, at the end of the year, they thought that they were going to cut the rates 4 times, so a full percentage, and they quickly changed their tune, where now they think they're only going to change it 2 times. Now, what we think is what the MBS highway forecast is, which is the mortgage-backed security highway, which we follow, is that the Fed rate is going to end at 3.375. And the reason we think that is because, well, a lot of the decision
3.625.
3.375. Oh yeah, 3.625. Sorry. We think that this is going to happen because a lot of the decisions that the Fed makes when it comes to cutting rates has to do with the unemployment numbers. And the one thing that was very murky last year was the unemployment numbers. Every time that we got unemployment numbers, we had to get crazy amount of revisions. So we didn't really know where the unemployment numbers really was until months after when they did the revision. And we think that the unemployment number is going to surprise some of the Feds, and that's going to make the rate go, or the Fed rate go, or that's going to force the hand for the Fed to actually lower the rate more than what they think they're going to lower it this year.
Yeah, and look, we have to understand that new administration with a lot of changes happening on the economic front, it's impossible to predict how this thing plays out, right? Like, are the wars all over the world going to come to an end? All of these things come into play, and it's very hard to predict, but the unemployment is the thing. Unemployment and inflation are the two things that drive the Fed's move, okay? And the expectation is that unemployment is going to go up from 4.2% to 4.5, maybe 4.6%. I know we don't want grandma or whoever to lose their jobs, okay? And I don't want to be a doomsayer with this whole thing, but the reality is this: we need unemployment to go up a little bit in order for us
Okay. We don't need unemployment to go up a little bit, okay? I don't know why he's saying that. Let's just, take that back. Scott's not saying that we need unemployment to go up. He's just saying if unemployment goes up, then the rates gotta go down, dude. You gotta be more positive than this, brother.
Listen, bro, I'm playing it real, okay? So this is where over here on the slide now is showing what the Fed members expect unemployment to do throughout the upcoming year. Okay, every one of them predict all of it to go up somewhere between 4.4 and 4.6%. And despite what my younger cohort says, the reality is, in order for an economy to work well and to be balanced, unemployment needs to be at a particular number. We are below that number now. So that is important. Okay, enough about that. Let's talk about the other big thing, which is inflation.
Inflation is the arch enemy of rates, and we've always talked about this. And look, I always like to put it in a very simple way. If you're going to lend money to somebody for 30 years, what you need to think about is, okay, if I'm going to lend them, let's say I'm going to give Scott a certain amount of money and he's going to pay me, and my return on investment is going to be $100 a month on that money that I'm lending him. Well, what I need to think about is, if he's going to pay me the whole money back in 30 years, I need to think about what that $100 is going to buy me, not just today, but also in 5 years, in 6 years, in 10 years, in 15 years. And as inflation goes up, that means that those $100 is going to buy me less and less and less. So what do? Next time that somebody else wants to borrow money from me, I simply increase the amount of money that I need to make back as inflation goes up. And this is why inflation is something that we have to look at all the time when we look at mortgage rates, because as inflation goes up, rates always go up.
Now, look, I mentioned earlier that I said I think the Fed is making the same mistake on the way down with inflation as the way up. Let me explain what I mean by that, okay? The way inflation is calculated, they literally take the last 12 measurements, all right, or readings, and average them. Okay?
12 months.
12 months, right? So when the February 2025 number gets released, the February 2024 number comes off, okay? And there's something called shelter lag, and shelter lag is a big part of this. So PCE stands for personal consumption expenditures. It's the Fed's favorite measure of inflation, not mine, but theirs.
Nobody cares what Scott's favorite measure of
I
inflation
care what
is.
I think it is.
So
my mommy didn't hold me enough when I was a kid. Please be gentle. Okay. So what I mean by this is this. Okay, shelter lag is housing costs and rent costs always go down slower than the rest of the inflationary reading. So,
but why is that? Because rents are typically a year. So, you know, right now rents are going down. But if you signed the lease 6 months ago, you're stuck on that lease for another 6 months if it was a full year. So, yes, we get the measures today, but for them to actually, you know, for actually hit the whole number is going to take a whole year. That's why it's lagging, because typically rents are 12 months.
All right, so let's take a look at the shelter readings. Look, it is hard to argue that although there's ups and downs throughout this journey, okay, the overall direction of shelter readings in the PCE is going remarkably down. And this is not yet really being factored in, because if you look at that chart, we're not just looking at today's readings, it's all the way at the bottom of that chart. We're still factoring in over the last 12 months, a lot of those readings that were much, much harder. So it's pulling the average up, okay? And there's no data that shows that it's gonna turn back around. So as the higher numbers fall off and are replaced by the lower numbers, it's going to drastically lower inflation. The Fed's not making moves quick enough, and again, they should be factoring this in. They never do. They did it on the way up. They're not on the way down, and that is why I feel that they are reacting too slowly to the inflation.
And the thing is, shelter, it's a big percentage of the overall reading of the PCE. So if shelter is such a big percentage, once shelter comes down, the overall number is going to come down.
Yeah, and as you can see on the chart there, the lower numbers are definitely lower than some of the other numbers that are coming off. So this is something that you could see a dramatic move in inflation just with 1 month's reading if the reading that it's replacing is much higher than where we are. All right, let's not get too nerdy on this, Ed. Okay, some more data on the same thing. All right, let's talk about inflation.
So this is the thing when we talk about inflation, and I think this one is important, because every time we talk about inflation coming down, everybody tells us, well, is it coming down because things are more expensive? When we talk about inflation coming down, we're not talking about prices of things coming down. We're talking about the rate of inflation coming down, meaning things are not going up at the same pace, okay? It's just like appreciation, right? We're not saying that now all of a sudden, you know, the whole basket of goods is going to be less expensive. We're not saying that. What we're saying is that it's not going to be going up at the same rate. So that's why it's important to talk about annual inflation versus cumulative inflation. Cumulative inflation is going to continue to go up. What we're saying is it's not going to continue to go up at the same pace. And it's important for us to understand this from this side. Yes, it's a little nerdy, but the truth is you need to understand that we're talking about inflation coming down, not about prices coming down.
All right, next we're going to talk about
labor. Yeah, you love this because you love killing jobs. So how about you talk about this, Scott?
All right, so look, the typical economic cycle that you see when you're coming off of low inflationary periods is that it's followed by some sort of a recession. And what triggers a recession is unemployment rates starting to go up. And as I said at the beginning of this, the labor market's been ridiculously resilient, way more than I would have expected, but it is going up. And as you can see the chart on there, we are seeing consistent, albeit slow, increases in the unemployment rates. Okay. And if we zoom in and we start looking at what they call duration, like the median duration unemployed, like how many weeks people are unemployed for, that number over the last period of time has really skyrocketed. And this is a very, very important thing to keep an eye on. Another thing we need to keep an eye on,
there's less jobs opening,
is this. Look at how many stores are being closed by these large retail businesses, okay? And you got to keep in mind, like when they shut down a Macy's, like how many people, think of the last time you walked through a Macy's, how many people are losing a job when a Macy's closes?
Walgreens.
It could be 200 people, 300 people in any one of these closings. So when we start looking at these things, these are a very, very clear indication of some leading indicators of some softness in the labor market. By the same token, there's a thing called a JOLTS report, okay? the JOLTS report is basically a reading of job openings, okay? The JOLTS report is consistently, steadily dropping. So all of these things, again, without nerding out on you, all of these things are the reason why we say we're going to see unemployment rise, not dramatically, not COVID, not 2008, nothing nuts, but we're going to see unemployment ticking up, which is, as contrary to logic as this is, which is good for housing and good for mortgage rates, which is the perfect segue to talk about rates. I'll keep going. Okay. He doesn't want to talk about rates because he has screwed them up in the past. Hold on. Did I screw that up? Yeah. Okay. So now, to know what's going on with rates, you have to follow something called mortgage-backed security bonds. We subscribe to that. Nobody else does. What a lot of people say is, I can keep an eye on the 10-year treasury, okay? And the 10-year treasury directionally usually moves in the same direction as mortgage rates. And there is truth to that. There are definitely exceptions and anomalies. But as a general rule of thumb, there is truth to that, okay? So what you want to see ideally is the 10-year treasury to be at or below 3.6%. And the other thing you want to look at is the relationship between the spread between the 10-year treasury and mortgage rates. And
Which
this number
typically stays around the same in the same area. By the way, that 3.6% target, we hit that last year at around September, and we quickly bounced up. And that's when we had those, lower rates for like a week, and then immediately the rates went back up last year.
But this is an important thing to know, everybody. When rates did hit that for a short period of time, the housing market got screaming hot.
Yeah.
Okay, we had a 60% increase in signed contracts during that short little window of time. And it was interesting, right? It's so perception based. I was talking to clients, and I remember one client specifically. I'm like, hey man, like we've been talking for a year and a half. Why did you pull the trigger now? And he said, rates have come down. I go, oh, that's interesting. How much did they come down? And he goes, I don't know, but rates came down, so it's a good time to buy. Ladies and gentlemen, perception is everything, and that is a critical piece of it. So we've hit this special number a time or two. They just, man, it was like, here again, gone tomorrow. And by the way, for the people in the room that are listening and they're like, I don't want to be a pushy salesperson, guys, you are hurting your clients, okay? If and when rates hit that number again, being pushy is what is in the client's best interest. Because I cannot tell you how many people I've spoken to since that give me some version of crap. I really wish I had done something when I had that small opportunity, whether it be buying or refinancing. Okay, so here is the spread that we were talking about, okay? And what you see there is the difference between, okay, there's two lines going across, is the spread between mortgage rates and the 10-year treasury. And as you can see, outside of that one little spike during COVID, this was very, very consistent, okay? And it's been consistent for a very long time. But look at where it is now. And by the way, that consistent number is about 1%. But look at where we are now. In October 23, we were at 3.1%. We're currently at 2.5%. So we do expect that spread to shrink. And the way that spread will shrink is the 10-year or mortgage rates coming down, getting more in line, because the spread between the two is simply too large now. Okay.
Another thing that's important here too is, look, there's a lot of volatility. And this goes back to what Scott was saying. It's not so much about being pushy when we can, but what we need to start doing is, one thing that we can easily say is, things are not going to go down or not going to go up in a straight line, because they never do. And in the past couple of years, the one thing that we've learned is there's crazy amount of volatility on everything. There's amount of volatility on the housing market, on inventory. Now, everything is going in the right direction, but in a very volatile way. What we need to start doing with every single one of our clients is we need to start preparing them. We need to have them ready to pull the trigger, because once those rates go down, or once things open up the way that we're expecting them to open up, we need to be ready to pull the trigger. So what is our expectation with rates, Scott?
All right, so look, we're looking, okay, if we can get that spread between the two down to about 2.25%, We think we could see a 10-year treasury about 3.5 or 3.6, excuse me. That's going to give us a rate somewhere around the 6% range. Okay. So rates in the high fives, maybe low sixes is where we see things being. Okay. Whether it's 6 months or 12 months is impossible to know, but we expect rates to be coming down in that range. And when Ed was talking about preparing, let me tell you the way we do the preparation with our clients for refinances. And by the way, if anybody listening to this is sitting at a higher interest rate and is waiting to refinance, hopefully this plan sounds good to you. Give us a call and we can implement this with you. What we're doing with our clients is we are taking their application, we are getting things ready. We have in advance what we call a strike rate, which is, hey, if rates hit here, yes, I want to refi. The numbers, the decision making, all of that thinking is done. So if rates hit that, our system will automatically lock the rate and they're ready to go. On the purchase side of things, it's the same thing. Hey, I want to wait until rates come down. Cool. How far down do you want rates to be? If they tell you 3%, we're never seeing that again, so don't waste your time. But if they say things like, if I could get something down in the 6.25 range, or, the low to mid sixes, something like that would make sense. All of a sudden now, you got to keep these notes in your CRM. So we are ready to go. Hey, John, I know you said you're ready to go and rates hit 6.5%. Guess what? Rates just hit 6.5%. I'm putting together some properties. I'm going to send them over to you. I want to go out with you this weekend. Guys, that is how you proactively manage your database and manage your prospect list to maximize the opportunities for you and, more importantly, for your clients. Okay, which is a perfect segue to talk about real estate. Now, for the agents out there, okay, let me break this down for you. There are 136 million households in America. Okay. Out of those 136 million households, there are 45 million renters. Now, obviously, 45 million renters has total equity of zero and average equity of zero. Okay. But we have 91 million homeowners. Okay. They're sitting on $53 trillion. Is that the right number? No, blind Scott. Okay, $37 trillion, which is about $407,000 in equity per house. Now, for people like as agents, this is great data to understand is that the average person in America is sitting on $407,000 in equity. So people that are looking to move down, maybe the rates don't matter at all, right? Yeah. Maybe the housing market doesn't matter at all. We got to start to think about how do we take these facts and turn them into conversations? Because throwing a bunch of data at somebody's useless, okay? If you're upgrading from a $600,000 house with 400 grand in equity to an $800,000 house, you have so much equity on there that the impact of the rate being a point higher is much reduced. Furthermore, and we've done a lot of classes on this, if we take some of that equity and pay off their debt, because consumer debt's at an all-time high in this country. Think home equity lines of credit and credit cards. Okay, average car payment's $800, etc. We could have them move up without actually moving the numbers at all. Now,
we also need to understand who are our clients. We're in Southwest Florida. A lot of people are coming here to retire. We need to understand now more than ever, what are the different strategies that they can have? If they sell a property up north, if they sell a property in California, they sell a property somewhere else and buy here. Look, I would say that in this climate that we're in, where rates are still high, because I'm sorry, even the 6% rate, it's not great, but that's where we're at. When rates are still high, but also equity is high and people are going to have cash in hand to come here, you guys as realtors need to understand, for example, how we can use things like a reverse mortgage for purchase in order to come here, buy a house, and not have a mortgage with a reverse mortgage for purchase. These are the little strategies that we need to have in our tool belt right now, because I think it's going to be huge for this year.
Okay, and this is the shit you do. This is what your generation does, you young people. Okay, let me just check everybody's perceptions on this. Okay. Saying 6% is not a great rate is bullshit, okay? If you look at the average of interest rates from 1971 to present, the average 30-year fixed rate mortgage in America over the last 55 years is 7.3%. So I would argue that 6% is actually historically a great rate. I remember the first house I financed myself because my second property.
My God,
Okay.
Grandpa, the first house I financed myself.
I locked myself in
This
at
guy.
6.5%, and I was doing backflips because I had never seen a rate that low. Okay, so perception check there.
Guys, put in the comment, what's the highest rate
Oh,
you
yeah.
had on your own house? I'm gonna start with mine. What's your highest rate, Scott?
The highest rate I've had is 8.25.
Ooh, you're old.
First house. Yeah, I'm old. Okay. So going back to the slide, okay, there are 56 million homes that are mortgaged, 35 million homes that are free and clear. By the way, the free and clear people are sitting on average, $571,000 of equity. Those people don't care about rates at all, okay? And the other thing, and this is big, everybody was talking about for the last, I don't know how many damn years, that the housing market is going to crash, that all these people are going to be upside down, and there's going to be this big 2008 collapse. And I've been very consistent in saying that's impossible to happen. Here we have another year proving that true. There are only 1 million people upside down. On average, they're upside down by $30,000, okay? To put this in contrast, in 2008, 1 out of every 4 homes in the United States was upside down. So to make any comparison between what we're looking at now and what we were looking at then is just simply false.
Scott, you're winning with your 8.25.
Oh, come on. Where are my older people, bro? Give me some 1982 people that bought houses then, man. They'll give you an 18%. All right. Now, another thing we need to look at, and this is not talked about enough, are the demographics, okay? And the demographics are everything, okay? And what you have on there is the boomers, the Gen X's, the millennials, and the Gen Z's, okay? And we see the population of this. If you look at the population of Gen Z and millennials, for example, okay? These are 2 enormous generations. And as you can see, as the generations get older, the home ownership rate massively increases. This is logical, okay? So right now, the Gen Zs only have an 8% home ownership rate. The median age there is like 20. Obviously, most 20-year-olds don't own houses. So that is absolutely critical. But let's start to look this forward a little bit. Hold on. Okay. There's one more in there. Nope. Okay. So if we look at this, okay, without getting into all the details, here's the punchline. As the millennials get older, okay, 8.5 million people should become homeowners. I'm saying should based on what's happened for the previous generations, okay? Now, some might be a little higher, some might be a lot lower. There's a lot of factors involved, but historically speaking, we're going to pick up an additional 8.5 million homeowners just by that generation aging. And guys, everything in economics is supply and demand. Nothing will ever change that. Okay, so that is 8.5 million people of increased demand. The next generation, Gen Zs, over the next 10 years, the home ownership rate should increase from 8% to 33%. Okay, that means an additional 17 million more homeowners. So those 2 generations alone, by just simply them aging, we're looking at 25 million home purchases that are going to happen. Maybe it's 21 and maybe it's 28 or whatever, but either way, this is an enormous numbers, okay? And if we're looking at 20 million people over the next 10 years, obviously that comes out to about 2 million people per year.
We have a 17%, Scott.
Nice. Let's
We're
go.
by a lot.
Let's go. Ask what year that was.
Well, he just asked what year that was.
Yeah.
What was that?
Yeah, that's so early 80s was the highest. I've had people tell me as high as 21%. Okay, so
that's aggressive.
And I know what everybody says, yeah, well, houses were 40 grand back then. Yes, and people made 60 cents an hour. So, you know, it's irrelevant. Okay, so now let's start looking at listings on a national level. Now, I understand that listings here in Southwest Florida are higher, but I still want a perception check, everybody, okay? A housing market here in Southwest Florida, where we're sitting on 6 or 7 or 8 months of inventory, is not this catastrophically bad number of listings, okay? And single family homes have been flickering in that range. A 6 months of housing inventory, like 6 to 7 months, is considered a balanced, healthy, like perfectly healthy housing market. Okay, now, I'm going to take a caveat here on the condos, because the last time I looked at the number of months of condo inventory here, in Southwest Florida, it was disgusting. It was like 18 months. Okay. 18 months of inventory in the condo market shows a super, super soft market. Okay.
Now, there's a lot of factors affecting
let's break down
condos.
why.
Like when it comes to the condo market, it's not just because, appreciation or because anything like that. The problem that we have with the condo is they're very hard to finance, and they're getting harder and harder to finance. Not because there aren't loans for them, but because the loans aren't as attractive with the recent changes in insurance. Look, when you're buying a condo, we're not only approving you as a client, but we're also have to approve the whole association. And when we look at the association, we need to make sure that the association is not in the middle of doing a lot of heavy repairs, which because of the hurricanes, there's a lot of heavy repairs happening. We need to make sure that the association has enough insurance and that the deductible of the insurance is not more than 10% deductible. And because of the prices of insurance, a lot of these condos have over 10% deductible when it comes to insurance. And we also need to make sure that they have enough reserves in their budget. And a lot of these condos don't have enough reserves in their budget. So, when we look at all of that, the condo market has become very difficult to get into because the pool of people that can buy a condo has come down because of those external factors.
And in addition to that, right, there's a lot of cash condo buyers. So what the heck's going on with that? It's very simple. Okay, I've had clients get hit with $80,000 assessments. I don't know how many deals we've gotten where the condo association was in a litigation with the insurance company, and not to mention the friggin' HOA bills have gone nuts. I had an agent call me up saying, Scott, I need your help putting together some buy down flyers for a listing of mine. The listing was a condo in Cape Coral by the water, an older condo. It was listed for like $289,000 or something like that. And the condo fees were over $900 a month. And I told the agent, and maybe I should have been more delicate, but I'm like, that listing sucks. Like a flyer is not moving that listing. I would tell my buyers, don't buy that place. Because here's the deal. The people that are looking at a sub $300,000 condo can't afford $900 a month for an HOA fee. And the people that could afford a $900 HOA fee aren't looking at a sub $300,000 condo. So the uncertainty of assessments, the uncertainty of rising HOA fees has made the condo market really tough. I got to be honest, personally as a buyer, I want to buy a condo right now for 3 years. I would want to see the dust settle on all this stuff to make sure that the condo I buy does not turn into a cash pit down the road. Okay, so that is what's going on with inventory. Okay, now on a national level, inventory is up 27% year over year. Again, I understand that is higher. But if you look at inventory, even here in Southwest Florida, and compare it to 2017, 2018, 2019, we are in the same general range. I encourage everybody, start doing that analysis, okay? You guys have access to the MLS, and start having those conversations with people, because what we need to do is perception check, okay? And you got to understand that the media is looking to spin things however they want. If there are 10 homes on the market, okay, and it rises to 12 homes on the market. Oh my goodness, inventories went up 20%. Yes, that's true. It's also true that there's 2 more homes on the market. And if you extrapolate that out to the bigger numbers that are more realistic, the same type of games can be and are being played by the media and all the people that are looking to grab headlines. All right.
Jared Simpson, my brother, he's saying, shocking to hear a mortgage person talk about interest rates and brush aside percent of income versus PITI. So that's very interesting because there's a lot of interesting data on affordability right now. And the problem with getting into that, Jared, is that if we look at that, we also need to look at wage growth. And when we start looking at wage growth, the numbers look a lot better than they are in reality than the way we feel it, just because, wage growth, we look at it globally as opposed to looking at the actual people buying houses. And this is something that's an unpopular opinion, even though affordability has gone down a little bit and it's very hard for people to buy houses, wage growth for actual home buyers have actually gone up. So it's not as bad as it actually seems, but that's a very fair point. But that doesn't really work with the predictions. The predictions today is interest rates and the housing market. And the housing market, beyond just affordability, has to do with supply and demand.
And look,
And the other thing with that, sorry, Scott, is if we expect the rates to go down, The stats are that for every 1% that the rates go down, that brings 5 million people that couldn't buy a house that now can afford to buy a house. So with this move of rates going down, we expect a lot more people being able to go into the market and buy more homes.
Yeah, and look, that being said, okay, I'm a father of a 23-year-old, a 21-year-old, and a 19-year-old. And my 23-year-old graduated college with her English degree. She wants to be a teacher. And she came back home. She graduated from FSU. She simply can't afford to live here. Like one undeniable reality is this: Southwest Florida has become a place that some people can't afford to live in. Okay, now this is not uncommon. All of Southern, I mean, I can't afford to live in Southern California. Entry-level homes start at $2 million. Okay, buying a house in Manhattan, Chicago, Boston. There are many, many, many sections of the country that some people just can't afford to live in. Okay, now my heart goes out to the first responders and the educators and the people that are struggling right now, and that's a very real thing. But there's not a lot of merit professionally of putting a lot of focus on that. I have served on the on all of the like kind of housing affordability committees at the county level to do what I can for that. But at the end of the day, we're trying to make a living, okay? And we want to try to help the people that can't afford to live here do so intelligently. Okay, now,
having said that, we're licensed all over the country.
Boom. All right, so if we just look real quick, okay, demand around 1.9 million homes per year. Okay, we're currently building between 1.3 and 1.6 million homes a year. So what does that mean? Okay, what that means very simply is that the demand, the gap between supply and demand is growing each and every year. So anybody who says that we're walking into a housing crash, we're walking into 2008, what goes up must come down, is just like numerically impossible, because the supply and demand.
Camera likes me.
I was gonna say broke that. There we go. The supply and demand mandates that prices don't crash, okay? And every year that goes on, we're another 300,000 below and another 300,000 below. The National Association of Realtors has been very consistent in saying that it's going to take at least 10 years to catch up with the demand, that's currently there. But here's my counterpoint to that. That's based on us building 2 million homes a year.
Which we're not.
We have never, ever in US history built 2 million homes a year. Now, can America's ingenuity and brilliance pull it off? Sure, it's possible. But to just automatically declare that we're going to jump up to 2 million new builds a year every year for the next 10 years is a bit of a stretch. So my personal opinion is it could take quite a bit longer than that. But whether it takes 10 years or 5 years or 15 years, either way, the rhetoric that the housing market's going to crash simply cannot happen. All right. So
where do we end? Nationally, based on all of this, we expect houses to go up another 4.1%. Last year, houses went up almost 5%. It was 4.6% nationally. We expect that trend to continue, although a little bit lower at 4.1%. Now, in Southwest Florida, we expect things to go up at about 3.8%. And the main reason is not because this market is not as strong, but because we do have more inventory. And as that inventory shrinks, that's when we're going to start seeing, more appreciation. But that's our expectation for this year. Now, look, if you look at this for the next 5 years, houses are supposed to go up 30 to 35%. And the point of this is, look, a lot of people go, well, 4% appreciation, it's not fantastic. But the problem is 4% appreciation year over year adds up pretty quickly. And in addition to that, you have to remember, when you buy a house, you're not buying the whole amount cash. So you can leverage the purchase of a home. You can buy a $500,000 house with a lower down payment, and that return on investment at even a 4% or a 3.8% can be almost $20,000. So a low down payment, like a $10,000 down payment, can yield you almost 100% return on investment.
And by the way, if we look at the Southwest Florida housing market for 2024, okay, the housing market went up. Yes, I'm saying up 1.9% last year, okay? And it's for the reasons that I just mentioned. Now, I understand the pushback. Scott, that's not true. I'm seeing all these price cuts. Let me ask you, agents, ask yourselves how many listings you've walked into where you told the client, the seller, I think you should list here, and you ended up listing some number above that. Okay. I was talking to an agent yesterday. She told the seller, you should list your house for $995. And he said, no, I want to list it for 1.2, but I'm willing to drop it $50,000 a month for 4 months to get down to your number. So guys, that's not the value of that house is not dropping 200 grand in 4 months. He's asking an unrealistic number, and it's taking him 4 months to get back to reality. Now, are there pockets of Southwest Florida where values have dipped some? Of course, okay? And anytime we're talking about the real estate market, there are 1,000 micro markets. So yeah, sure, there's micro markets where things have been hit. There's no arguing that, particularly with the hurricane and things of that nature. But as a whole, in Southwest Florida last year, single family homes went up 1.9%. Okay, and that is a very critical data. So let's summarize this. Okay, whoops. So nationally, 3%. I'm sorry, nationally, 4 to 4.5% appreciation. We're thinking sub 4% here locally. Inflation's going to be between 2.1, 2.2. We want that. Unemployment rate's going to rise 4.5, maybe 4.6. We think that the Fed funds rate is going to see most likely 3 rate cuts, 3 to 4 rate cuts, not the 2 to 3 that a lot of people are predicting, including the Fed members. And we're expecting mortgage rates to decline somewhere around 6% over the course of the year. And like Ed said at the beginning, for the love of all things good in this world, please, let's stop talking about things like you marry the house and you date the rate, or rates are going to come down and blah, blah, blah. Because all we're telling people is don't buy. Look, we did some data. I didn't put it into the presentation because I didn't want to geek out too much. But if you bought a house, if you didn't buy a house in 1991 and you were waiting for rates to come down, you would have waited like 17 years for rates to come down. And during those 17 years, home prices went up 300%. So we cannot look at whether or not buying a house is a good purchase or a bad purchase based on one component of it. Now, if you simply can't afford a house at 7% and you can't afford one at 6%, that's just math, right? That's different. But we need to make sure that we're having people look at the big picture of it, because a typical appreciation rate historically in America is around 3%. So if we're sitting at numbers, even last year at 1.9%, these are not bad numbers. But here is a boldest prediction for next year. A boldest prediction for next year is that the number of leads received will go up significantly. Ed, I know you've been dying to talk about this one. Please take it away.
So look, there's 2 things. I think things are going to go up significantly organically. Organically, I mean, there's a new administration, which a lot of people were waiting for that in order to make a decision to buy or not. I think that now the Fed, it's going to start cutting rates, whether it's 2 times or 3 times or 4 times. That's going to hit the news. And, we know in the real estate industry that doesn't mean that the mortgage rates are going to go drop immediately, but the news is going to be the Fed cut the rates. And that's the great news that people are waiting for. At least they think they're waiting for, in order to jump into the market. So I think that the decision to buy a house is going to be a lot easier for people, whether it's for the right reasons or the wrong reasons, it doesn't matter. It's going to be a lot easier. Now, that I think is going to happen organically. What we're super excited to talk about is that now Neo Home Loans is in partnership with Better.com. And Better.com right now has a little problem that we all wish we had. And the problem that they have is that they are getting 30,000 leads every single month. And the 30,000 leads that they're getting is not real estate leads. These are mortgage applications. These are not people that just clicked on a house because they want to see the house.
It's
not landing trees, none of that. It's
shit.
people that actually are submitting their credit score, we're pulling credit, they're submitting their documentation, they're submitting everything. And they need help converting those leads, and that's why they joined us at Neo. We are here in the state of Florida, and we're going to be handling a big part of these leads in Florida, if not all of them. So we also need to partner with good real estate agents to be able to give them those leads, because what we need to do in order to continue to get these leads is to convert them at a high level. And this is why organically, yes, we're going to get more leads because things are going to be bright for people that want to buy houses. But inorganically, we're going to be able to provide you guys with a lot more leads because we need to start converting these leads. And at 30,000 leads, that's about 2,800 leads every single month just for the state of Florida. We're going to need to partner with good agents. And this is where we need your help. We need your help because we need to convert them. We need to work with agents that not only are going to convert them fast, but that are able to influence their clients to continue to work with you as an agent and with us with Neo Home Loans and now powered by Better.
And if I could jump in, I was talking to an agent about this. He's like, Scott, I'd really like to be a part of this lead program that you have and blah, blah, blah. We've known each other for a lot of years. And look, guys, we got to make, like, Ed and I have to make business decisions with this. And I said, hey, man, that's fair, but I haven't gotten any business from you for the last couple months. And his answer was, yeah, but everybody I've talked to that's financed already had their lender in place. And I didn't say it because I didn't want to be a jerk, but like I thought to myself, if you don't have enough influence over your clients to at least get them to speak to me, whoever they close, if they speak to me and don't close to me, that's my fault. But if you don't have enough influence over your clients to get them to at least speak to me, I don't know that I have confidence that you're going to have enough influence over your clients to actually get them under contract, right? That you have the sales skills and the scripting and the whole thing. It's complicated, right? It's hard. So we're looking for agents that have the right level of influence over their clients where we could have a true mutual back and forth of leads going back and forth.
Anyways, team, we're going to need people that can work in different counties. We're looking to find about 2 agents per county that we can feed these leads to, and we can really work together to convert these leads at a high level. Because right now, what they told us is they have a digestion problem. It's not that they can't get enough leads; they have a bunch of leads. We need help. We need to help them converting those leads. And who better than you guys, the realtors that know us, and that, hopefully we can do the partnership together and work well with this. If you're interested in this, we haven't worked together, or if we work together, but you're interested in working together to this level, please let us know. We're going to send you an email with this recording. We're going to send you also an email with all of these, with the slides. Reply to that email, and let's get together and talk about how we can work better this year.
And look, if you have any experience, maybe you receive leads from Zillow or Sync or whatever, and you have any data that shows you conversion numbers, please, when you respond to that email, share that with us, because we have to be extremely strategic in where this is. And although we are looking for 2 agents per county, there are some counties like Lee, like Collier, like Broward, like Dade, like Hillsborough, where there's a significantly higher volume of buyers, therefore a higher volume of leads, and we might need 5 or 10 agents in some of these areas. So I don't want you to be discouraged by that, but we're going to have to figure this out. The leads should start coming during the second quarter of this year, so as early as 2 months from now, but we're trying to get these relationships in place in advance, so we're not scrambling when the leads come in. Because again, if the leads aren't converted by our agent partners, not only does the agent stop getting the leads, but we will stop getting the leads, which is why we need to be so super strategic with this. All right. Bro,
thank you very much.
Right on schedule, guys. Thank you so much for taking the time with us. Anything you need, always let us know. Keep your eyes open for future webinars and in-person classes that we'll be doing. And let's kick butt together in 2025.
Hey, we have a couple of CE courses coming in the next 30 to 45 days. We'll set you the invite on this email as well.